Well, joining me now is Ying Yi Ann Cheng from Coolabah Capital, and she's a portfolio there. And that company manages the Switzer Higher Yield Fund as well. And she is our interest rate expert, and we all care about interest rates. Tell me this, Ying Yi, do you think the lockdown and the potential economic implication of the lockdown will actually mean that the Reserve Bank will be on the sidelines for a lot longer than some people were expecting?
Well, yeah, that's a very good question, Peter. I mean, look, there definitely is a bit of a shock from the latest lockdown. However, having said that, markets haven't been pricing in, RBA rate hikes for quite some time. Obviously, as we've spoken about in the past, they're doing quantitative easing, i.e. they're buying Commonwealth government bonds and state government bonds. And so we would expect that they taper back on these bond purchases first before they actually start hiking rates in the future. And so, in terms of implications for the RBA, in terms of looking at the lockdowns, look, if we do have, economic sort of activity, turning down, which is going to be very likely the case in Q3 and possibly Q4 this year, then it may be the case that they decide to taper back on their, delay that taper on their bond purchases, which would then, arguably, potentially push out, rate hikes into the future. So, we think that they don't hike rates in 2022. So our base case, even before lockdowns, was that they probably start thinking about hiking rates in late 2023 or possibly 2024.
Yep.
It may be the case that if economic activity doesn't necessarily bounce back as quickly, despite higher vaccination rates, etc., that some of those rate hikes could be pushed out. But it's still a long time yet.
Okay, so were you a little bit surprised that the Reserve Bank stuck to its guns in talking about reducing the taper? Because I think when they first introduced it, you were a little bit surprised. I must admit, when I heard, what the way the economy is going, and like NAB even thinks the June quarter could have been a small negative, which means that we're in recession now. I think I'll be wrong, but there's a possibility. I thought the central bank would say, well, look, we'll hold back on reducing our taper, but they didn't. Did that surprise you a little?
Yes, that did surprise me. In fact, look, we weren't alone. We thought that maybe they would stick to their guns and sticking with $5 billion a week. And, in fact, banks like Westpac, Westpac's Bill Evans, who I'm sure you're familiar with, was calling for $6 billion a week. And so, the fact that they stuck to their guns and said, look, we're going to do $4 billion a week starting from September, reflected something that they were, looking at their forecast rather than looking at the data in front of them or what could possibly pan out. So, we were dealing with an RBA which seemed to be, a glass half full. And in that respect, I think, the point that they did emphasize, though, in the August meeting last week was that they said they would be flexible, right? So it could be the case that we get to the September meeting and they say, actually, because of this flexibility and because of the way that the data has panned out, we may not choose to move to 4 billion. That's still a bit of a question mark because, we're yet to sort of see, we know what the implications could be, but obviously, as you know, it takes a bit of time for, job losses to feed into the data. And, when we do get the next set of jobs data, the July data, because not everyone was in full proper lockdown and people arguably may not have lost their jobs yet, that wouldn't necessarily be reflected in the jobs data either, because even if you worked for 1 week in the month of July, you're still technically considered to be employed.
Okay, let's go to the US now, because they got a very good job number. The bond market got confident again, so yields rose, and tech stocks suffered as a consequence. What's your take on the US economy and the bond market over there? Because ultimately what happens in the bond market over there is going to have an impact on our stock market as well. And I guess if the Fed raises interest rates ahead of schedule, would that put pressure on our central bank to follow suit? All those sorts of questions.
Yeah, ultimately, we do believe that, you know, the US will hike rates before Australia does. The US and Australia were in slightly different situations, you know, before COVID anyway. The RBA had the issue of, you know, pre-COVID, they actually weren't meeting their inflation and employment objectives, whereas, you know, in the US, it was a slightly different story. Now, the US is obviously bouncing back. There's economic activity, and they're obviously running a very different policy to the way that we're running our country, right? We, you know, rightly or wrongly, politically sort of speaking, we are, you know, heading towards 0 cases. And at least that's how the sector individually running this sort of mandate. Whereas in the US, they've focused on, you know, vaccinations and rolling out that vaccination. So obviously they're ahead of us in that vaccination sort of program. And, you know, people can, you know, freely travel. Obviously there's some sort of health restrictions that we are seeing, and maybe that does provide some sort of a template for us in the future, you know, whether we need to get some sort of vaccination passport or proof that we are vaccinated, etc. However, you know, their economy is playing out because they are getting that sort of, you know, economic rebound. And so that's probably a template for how we would probably look next year. But until we get our vaccination rates higher, it's unlikely that we'll sort of see that. So in terms of the US, yes, you mentioned, you know, would they start hiking rates? And look, you know, the central bank over there, the Federal Reserve, have said that they would, you know, taper back, and heading into Jackson Hole, which is, you know, the key sort of central bank meeting, I suppose, for on the economic policy calendar. It does seem that there's a bit of a almost like a coordinated effort amongst the central banks to really stick to that sort of, we are going to taper talk. We've seen it from the Bank of England recently, we've seen it from the Federal Reserve, and even to a certain extent, you know, the RBA as well last week. So it'll be interesting how that sort of plays out. But, you know, the Delta variant, as we know, is very rampant, and we're seeing, you know, an escalation in cases offshore. But to a certain degree, you could argue, you know, the central banks are probably thinking, hey, we've actually done enough. We've been supporting the economy since last year. What more else can we do? So yeah, that's something to bear in mind, but I guess we'll sort of wait and see.
One last question, because, you know,
Yes.
we have been, for me, pathetically pessimistic, which I don't like being. But let's skip into 2022. You kind of implied it, and I think this will happen. If vaccination rates are good by December, January, I think it prepares us for a really strong 2022. Is that a fair call?
Yeah, I think I'm quite bullish on 2022 as well. So I think you'll get about, just purely from economies reopening. So you could have, you know, potential sort of rebasing effects on one hand, but the fact that, you know, there's all this pent up activity because businesses just simply can't operate, people can't actually go out, that's going to be fully sort of open in 2022. So you probably expect, you know, wages and inflation to sort of, you know, pick up. And that potentially does, you know, open the door for the RBA to start raising rates in 2024.
Yeah. A hairdresser friend of mine said to me, if these lockdowns don't end soon, we're going to lose 500,000 of blondes out of Sydney.
That's awesome.
I think that's what's going to happen. There's going to be so many people wanting to go to the hairdressers, wanting to go to restaurants, wanting to do stuff. That's going to really be a big economic boom in 2022, and people should be investing accordingly, I reckon. Ying Yi Ann Cheng, thanks for joining us on the program.
Thank you so much, Peter. Take care.